Hi everyone and welcome to the weekly update with me, Richard Perrin, market analyst at Hantec Markets. Each week I take you through the key events I believe will be driving your investments in the coming days. Now, moving into this week, we had news at the weekend that Theresa May was sort of moving towards triggering Article 50. She was saying that it's going to be done by the end of Q1 next year, and subsequently we saw a significant amount of volatility on sterling today. But the main drivers coming into this week was certainly still Deutsche Bank is an issue for the risk sentiment and the potential for contagion running through the bond markets, and also the fact that we're now increasingly going to be looking towards the presidential election in the US as a driver of volatility. But Deutsche Bank certainly at the moment seems to be sort of the market concerned as to whether it can pay this $14 billion fine. It certainly looks as though it's likely to be renegotiated downwards, possibly even back to sort of towards 5 billion. But I think it still has a bit to play out, so watch out for that in terms of volatility through this week. But generally speaking, as time goes on, I think we're going to become increasingly more focused on this presidential election in the States. We had the first debate last week. That caused a little bit of volatility, and I think as we go on in the coming weeks, that will add up ever more in terms of the volatility stakes. In terms of what we're looking for this week on the data front, well, we've got the PMI data, which starts off through the first part of the week. We had the PMI manufacturing numbers on Monday, and we're sort of looking towards the services data on Wednesday as well, the PMI services. But the main sort of focus will be on non-farm payrolls Friday and the impact that that could potentially have on the potential for a rate hike in the States. Now, in terms of your services PMI or your PMI data, you'd still be looking for the US PMI to improve again, because it had a very disappointing month last month on both in non-manufacturing and manufacturing. Really disappointing, and subsequently the market sold off on the dollar. Dollar's recovered somewhat since then, but I think we're going to continue to see this sort of dollar fluctuation around the data. Now, looking out towards non-farm payrolls, it seems to be as though it's going to be a bit of a sort of a flat, middle-of-the-road payrolls report this month, but it certainly would still, I think, drive the volatility in the market. I think because we're sort of looking for a December rate hike possibly, means for the next couple of months, good news on data points from the States will be treated as good news for sentiment, because I think the market is fairly settled for December. Now, in terms of what we're looking out for in the Forex markets, well, we've seen the dollar, which has sort of been gaining somewhat in recent times. That's coming with a little bit of safe haven flow. And also, I think the market is, as I said, settling for this December rate hike. In terms of your euro-dollar trade, it's such a boring market at the moment. Really is the most widely traded instrument in the world. Is incredibly flat. It's not really going anywhere. It's not really showing any real signs of a breakout. It seems to be trading in a tight range between $1.1120 to $1.1325. With no real expectation of a breakout anytime soon. In terms of dollar yen, again, we've seen a little bit of a recovery, as I said, through that dollar rebound in the last few days, but we're still trading in a big downtrend phase, and it could once more be a situation whereby the dollar rally gets sold into, because the yen still seems to be a bit of a sort of a preferred trade there. Now, the big mover of Monday, and I think will be throughout this week, will be cable, because sterling has been sold off massively on the announcement over the weekend that Theresa May was set to trigger Article 50 at the end of Q1 next year. Now, in terms of exactly what this does for the UK, it seems to be that markets are taking it that the government will be focusing more on the immigration side than sort of single market of the EU, and hence why the sterling has been sold off. It hasn't yet broken the key floor at 127.96, but if it does do that on a closing basis, we could see a big technical breakdown around about 650 ticks of downside potential there on the pattern breakdown, and subsequently, obviously, a big sell-off would be in process. Now, for this week also, we've got the Aussie dollar, which is in focus because we've got the Reserve Bank of Australia with the monetary policy meeting. No expectation of a rate cut from 1.5%, but you could imagine that there would be an amount of jawboning down of the Aussie dollar due to the fact that the Aussie has been fairly well supported recently, so the RBA would certainly want to have that lower. But Looking out for your equity markets, it's very interesting because we've seen with this sterling weakness this morning, FTSE 100 bursting higher, up above the 6955 key resistance that it posted in the summer, and it could continue to go. If it closes above that, that reopens the high. 70.70 is a resistance, but 71.22 is the all-time high, and that could well come under pressure if the market continues to run on. And certainly a weaker sterling helps the FTSE 100, so watch out for that. The DAX, it's a different story because it's been held back by the volatility surrounding Deutsche Bank and the concerns that they've had on European banks. But certainly I think if the Deutsche Bank situation gets sort of calmed down a little bit, we could see a bit of a DAX rally, and that could help to drive the market higher. In terms of your S&P 500, well, as other markets, and certainly the FTSE has done on Friday and today, that the S&P 500 is looking to push once more higher, back towards its highs, and it's 2,194 is the key resistance there, and we'll be looking to see if that tests that key level. In terms of your commodity prices, we've seen the gold price, which has just been, again, another market where the medium-term trading range has been continuing for the last few months. Now, this market has now broken the long-term bull trends. Now, the uptrend that's been in place since December, and also the 89-day moving average, which has been supportive, have now been broken. I think this medium-term trend could continue. There's no real suggestion on the technicals yet that a breakdown below 1300 is likely to be seen. I still think we're going to see buys at the around that sort of level between 1300 to 1310, and I would still continue to treat this as a range play. Oil is another one that is a very key market, and it's been significantly pushed higher on the back of that OPEC oil agreement. Now, I think the agreement to cut production to 32.5 to 33 million barrels per day is very important, but it'll be interesting to see if they can actually implement it now, because this is the key situation. Now, the OPEC meeting at the end of November will now become very interesting in terms of exactly how these countries can get together and organise this production cut. But it likely seems to be the case that oil is now supported, and it looks to be pushing higher on the resistance levels. Now, in terms of your economic data that we've got through this week, as I said, we're focusing front end of the week on the PMIs. Manufacturing been out on Monday. Wednesday we've got the services data, but also we've got the RBA on Tuesday, but mainly moving towards this non-farm payrolls report on Friday. This will be obviously the big volatility event in the week. No real surprise there. Can the expectation of 170,000 jobs be hit? Can the unemployment rate stay at 4.9%? And also, probably as important, can the earnings growth start to improve again? It had a disappointing earnings growth number last month, 0.1% on the monthly basis, on the monthly data, but the market will be certainly looking out for earnings growth to pick up and start to drive the market forward in terms of its expectations of a rate hike because of the inflationary implications of rising earnings. So non-farm payrolls report could be a strong one this month, and strong for the dollar if it is that case. So I wish you good luck in your trading this month, this week, and I'll speak to you soon. Thank you.